Hello, hello,
You
everyone out
laughing
there in
already?
podcast. The face you made as soon as I clicked go live.
I'm
Look how
going
he's
to be
counting you,
friendly. I'm going to
Josh.
smile.
Oh man. Hello, everyone out there in podcast world. Hope you're having a wonderful day. You're listening to or watching the Service Business Mastery Podcast. I'm one of your hosts, Tersh Blissett, sitting virtually next to my co-host, Joshua Crouch. Looks like you're moving. You just moved into your house. You got the
No, those. I don't think my employees watch the podcast. Those are for them. Those are Christmas gifts. I just haven't.
surprise.
I haven't sent them out yet, so hopefully they're not watching this. They
That's
were up
hilarious.
here, but now I
Yeah.
moved them down here, so we actually got them out of the house.
Yeah. You got to pay overnight shipping by the time it's all said and
Yes,
done.
yes.
Yeah.
So we got to get those things going because it's already
Anywho,
almost the 10th.
right. So I'm excited to talk about today's show. We're going to talk about different things with Catherine Tindall. Did I say that right?
Good job.
Yes,
Good
I
job,
did.
man.
Tindall.
We're gonna put that one in the bucket. You did it right.
Yeah. So she's a CPA partner with Dominion Enterprise Services. And we're going to talk a little bit about the employee
Retention tax
retention credit. I was thinking of the ERA. Yeah, ERA. Man, my brain is just mush. We haven't done a live in a couple weeks now. We're out of town. The ERC, employee retention credit, and it's funny because when 2020 happened, and I first got wind of this, I was in one of our coaching groups, and they said if you're not taking advantage of this, you need to be talking to someone about it. And so immediately I put a post on LinkedIn. I said, anybody that can talk about this employee retention credit, please message me so that we can talk on the podcast. I had like 3 or 4 people message me, and they were like, yeah, I don't want to talk on the podcast, but here's some information about it. I was like, I'm definitely not going to talk about it because like I can't even read a one sheet without screwing that thing up, much less for something that actually has to do with taxes. So I asked a lot of people about it, and then just so happened that Catherine, she actually fell into our lap here through some people who we actually book a lot of episodes through, and so I'm super excited to talk about things that I am 1,000% ignorant when it comes to. So it's
Same.
basically going to be like every other conversation that we have. So.
We're just gonna shut up and let Catherine talk.
Right. So before we get started, though, I want to give a huge shout out to Upfrog and some of the people that make this show possible. Upfrog, if you are not familiar with them, they have a program called Refrog. And so if you have clients, which we all do, that we don't engage with properly or we don't talk to as often as we should, Refrog is that program that they have to re-engage with clients that you haven't engaged with for several months or even up to a year in some circumstances. And it's a really cool conversation. The way that they do things, it's not that weird spammy call or spammy text message that we all get. It's very conversational, and I thought that was a really cool thing that Justin and Noah came up with there at Upfrog. So huge shout out to those guys over there. Josh, you want to tell us a little bit about Sarah?
Yeah, so Sarah was actually the first sponsor of our show. As you guys that have been listening, or if you're just tuning in, your first episode, because we're talking about tax credits and everyone wants money back from the government, or at least keep more of their money. So if this is the first time you're hearing us, Sarah's one of our initial sponsor, and they are CRM program, and they are focused on the things that are going to help you have a healthier net profit. So you're going to have to talk to people like Catherine about how to save money on taxes, because they focus on job efficiency and things like that, simplifying the warranty process, which can be a big pain, and automating dispatching. So that way you don't have to have a ton of internal office staff moving pieces around your dispatch board and stuff like that. So, and honestly, Billy's just a really great guy. He always he posts his Billyisms. If you ever follow him, Billy Stevens, on Saturday mornings, he posts his Billyisms, which is like his kind of like his life story as he's been in the trades. And it's been really great. He posts some really engaging stuff and some really great stories.
Yeah, they really are. They're very thoughtful and well thought out Last but definitely not least, Company Cam. It's a damn digital asset management tool. I love saying that every time because I don't do it. That's not my realm of things. That's Josh's, definitely doing digital marketing. But Company Cam is really cool because as a technician, it was always very annoying to me, and it still is annoying. I have guys that'll give me an iPad, and they're like, "Oh yeah, I'm out of data on that one," and it's because they have a gazillion pictures of data plates and condenser coils and evaporator coils and dirty air filters. And Company Cam is that program that stores all that data and those images and actually geo tags them all. So whenever you do upload it to Google, to your website, that geo tag is very Google or Bing or Yahoo friendly. So Company
Yeah.
Cam is pretty cool platform. There's a lot more going on to it, but we have a discount code with Company Cam. It is 50% off. Well, the first month's free, and then 50% off for the next 3 months. So yeah, we'll put that link in the show notes. Did I miss anything, Josh?
No,
You sure?
it's good to be live with you again.
Right?
Are you looking for valuable business advice to reach that 7-figure revenue mark? Do you want actionable tips to properly navigate through every business challenge you encounter along the way? Let Tersh Blissett and Josh Crouch be your guide in getting you to the top here at Service Business Mastery. Tune in as they sit down with world-renowned authors in business, leadership, and personal growth who share valuable insights about management, marketing, pricing, human resources, and so much more. Let their nuggets of wisdom gold guide you in owning a thriving, profitable, and ever-growing business. Here are your hosts, Tersh and Josh.
Hey, Catherine, how are you?
Hey, good. How are you?
Welcome.
Good. So I really like this. I'm super excited to talk to you, especially because it's your specialty tax advisory practice, and you really, obviously, based on what I've learned and read about you, you focus a lot on the employee retention credit and people who are eligible for it, and what it even means to get a credit for that and all that good stuff. But with that being said, I'd like for you to take a quick moment to introduce yourself and who you are and a little bit about yourself.
Sure. So my name's Catherine Tindall. I'm a CPA. I'm a partner with Dominion Enterprise Services. We're a specialty tax and accounting firm. We do a lot of work for businesses with the employee retention credit. I actually teach other CPAs how to do this work and do a lot of work for other practices that don't feel comfortable with it because it's it's a complex program. It's a one-time COVID thing, but it's a lot of money on the table for clients. So it's one of those kind of hidden diamonds still left over from the pandemic.
Why did you guys, I'm assuming this was a decision that you guys made as a firm to specialize in this. Why did you specialize in this credit?
I think for us, it came, when the program initially came out during the pandemic, we decided, well, if I'm going to do one of these, I might as well do 1,000 of them because the amount of setup time to actually learn the credit properly and be able to execute it, that was kind of a choice we made early on. And then two, we have, myself, I'm very much a systems and technology person. So I enjoyed the challenge of working with a program that had no tax software for it. So we had to develop our own, internal systems and automations to be able to do the work with a high quality control level that you get when you do things with tax software. And then also my partner in the firm had an extensive research and development tax credit background. So he was used to, kind of the IRS audits that go on with credits and just kind of the general dealing with the IRS that goes on with programs like this. So we felt comfortable from that standpoint as well, because a program like this, the big boogeyman is the IRS and the IRS audits. So between us, the two of us having those two specialties, and we started to do them for our own clients. And then other CPAs I was friendly with, started asking us to do their clients. And then it just ballooned into, a whole practice area for us. And then we started doing education on the credit. So we do continuing education for other accountants, teaching them how to do this work, because it's.
I think one of the biggest things is like you hear, well, the IRS just hired 88,000 new people. And then
Yeah.
you're like, this is employee retention credit. Like maybe I can just wing it. And then you're like, in the back of your mind, you're like,
Yeah.
88,000 new employees for the IRS. Like,
There's probably some people in there doing some quality control to make sure stuff isn't sliding past somebody else.
Yeah. And they
especially
have a special
since,
task force for this. So
well, that's exactly what I was going to say. Especially since there's so much money available
yeah.
for this, I imagine that they have people who are specialized in this. The funny thing about the IRS, it's that conversation. It's like whenever I was in school and I would get home from school and my mom would say, "So, tell me about your day," and I'm like, "Oh crap, what did I do?" And then she's like, "Just tell me about your day," and I'm like, "No, no, you know what you're talking about. The IRS. I know how much money you owe me. Well, tell me." "No, I'm not going to tell you how much money you owe. You have to figure it out. And if you make a
Yeah.
mistake, then
Yeah.
it's on you."
Yeah.
And that's exactly how I feel. I feel very backed into a corner and very uneasy about it.
Yeah.
So whenever it's like, oh, $26,000 per employee that I retained, like that sounds pretty awesome.
Yeah.
Can you go like, first off, can you tell us a little bit about the qualifications? If you haven't done X, Y, and Z, there's a strong possibility you haven't taken advantage of this credit.
Yeah, so I'd say, for most businesses and especially for service businesses, the first thing, the real consideration here is, well, you're not going to try to do it yourself. So how do you know if you need to talk to somebody about it? I think the bigger question too for a lot of people, since, they've maybe have had a conversation with their CPA about it, maybe not. The two pieces that I tell people that you want to watch out for to see whether or not you've actually been assessed by your tax professional. The first is, there's two tests for the program. The first test is a revenues-based test. And so if your tax person doesn't have access to quarterly financial statements from your company from tax year 2019 through the third quarter of 2021, if they don't have access to those quarterly financial statements or requested them from you, they haven't tested you for the revenue test because that's what you need for that. The second piece is if they haven't had a conversation with you about, how did the government interact with you during the pandemic? Were you subject to any kind of government restrictions in how you operated? Were you subject to things from state orders or local orders or, some other governmental agency that forced you to modify how you were operating? So if they haven't had that specific conversation with you, then you most likely have not been assessed for the credit. And that's usually the place I start with people is you want to make sure that you really are being assessed for it, because it's easy to try to read the rules yourself and think, oh, I don't qualify, or oh, that's not me. But if you don't have a tax background, it's like if you got a mole on your neck, it's like you're just going to assume it's cancer until you've got a dermatologist tell you otherwise. Like you got like a big hunk, and it's like you don't just wait. Or like, I don't know, I'm going to go on WebMD. Like I'll figure it out myself.
Yeah, exactly.
This is not a situation like that.
So, well, let me ask this. What's the date? Like, is there an end date and a beginning date? And what are they?
Yeah, so the program for most businesses, it starts in 2020 and it ends in the third quarter of 2021. It's calculated on a per quarter basis, and it's done, either by you meet certain revenue declines, and that's a quarterly thing. So if you had any kind of revenue declines during the pandemic, just send somebody your numbers, have them run it. Or, if you had those government interferences, you can qualify for the duration of a, government interference that meets certain, tests from the IRS.
So with that government interference, what happens if it's like a secondary result of them closing something down? Like, so let's take, for instance, St. Patrick's Day, massive event in Savannah. That's where I'm at. It's in Savannah, Georgia. It's I like the second largest St. Patrick's Day celebration. and it's a major revenue generator for a lot of businesses, especially restaurants downtown Savannah. They'll take losses all year and then make it all up on St. Patrick's Day. Well, the week before St. Patrick's Day, the city of Savannah canceled the entire event, put everybody on lockdown. Like, you couldn't go out, you couldn't go and do things without fear of everything going on. That did not directly impact our HVAC and plumbing business, but the fact that all these restaurants were shut down, that impacted it. Does that qualify, or is it just the restaurants that would be qualified?
Yeah. So in a situation like that, and how I usually explain it to people is, the compensation to you as a business owner for just general disruptions during the pandemic, I think the mindset of Congress was, okay, well, if you were really messed with during the pandemic, it's going to show up in your revenues. So that's a quantitative test there versus, what's going to qualify, right? So that's one half of it. So it's like, if you were really messed with, it'll show up in your revenues. And then the second half of it is, well, if we messed with you directly, that's not potentially going to show up in your revenues because we're creating a phantom loss. So for instance, like with a restaurant, and restaurants in Georgia, they were subject to state level restrictions on indoor dining capacity. And so maybe they did okay from a revenue standpoint because they absolutely hustled. But had they been able to operate at 100% capacity instead of 40%, that hustle would have generated a lot more money than what they actually were able to do. And so that's what the compensation mindset is. So to answer your question, kind of with that background, you are really looking for a direct government interference. So it needs to be something like, for something like an HVAC company, it would be things like any non-essential, residential grade work, maintenance work, or non-emergency work is suspended per Governor Order X. That's the kind of thing that would be a qualifying event. You have to be able to find the actual government orders because that's just what the credit hinges on in the language of it. And so for most businesses, it's really going to be contingent on like where you are, where you operate, and then what you do and how much you interact with the public. Because if you live in a state, like for instance, Washington had specific state orders where non-essential, you weren't able to do any like construction work that was related to like non-essential activities. So if somebody
maintenance related or whatever.
So if somebody, for one client we had, he was a paving company, and so he wasn't allowed to pave anybody's driveways for months because of that state restriction on him. So that's the kind of thing that we look for, and that's something where you want somebody actually finding the government orders and being able to prove it out because it involves like a legal interpretation.
Mm-hmm.
So is that something that your firm, do you guys help find that stuff, or is that
we have an attorney that's all he does.
Okay.
Yeah.
Well, that's definitely helpful because that's hard to find. Like, where do you look? Like, you could look in Google, but you don't really know where you're looking. Like,
and
somebody could post something that's not legal.
Yeah, and so that's the thing is like we'll go on government websites. Sometimes not all the information's there, and we actually have to track down somebody in the office that it's related to and get a copy of, whatever the order was or whatever the situation was. And it requires some digging, but it just depends on what was going on, and where you were located and what you're subject to. And, usually the place to start is that conversation with the business owner of like, okay, what do you remember? And then was this from the state? Was this from your local health board? Who is this from? And then it's really just on the provider to go and actually dig all that up and make sure that it really does. Because we have it sounds like a vague thing to say that, government orders, were you subject to something? But we actually have quantitative tests from the IRS of what constitutes enough of a disruption to qualify a business. So we have to do all that analysis as well and make sure, okay, this is what the government order says. This is what this business does. Do we meet these different tests from the IRS that this was disruptive enough to qualify?
Okay. And you guys have on your website, you have like a short questionnaire, right? That goes over, like, you can kind of see like at a real basic level if you think it'd be worth even having like a conversation.
Yeah, because it's, usually I tell people if you've got more than 10 employees and your revenues weren't consistently going up every single, going up or maintaining during the pandemic. So if your revenues were very stable during the pandemic and you know that you weren't subject to any kind of restrictions. So for instance, in my profession, accounting, almost everywhere we were deemed essential. We're able to telework, no real restrictions on our work. And then for like most accountants, your revenues didn't change too much during the pandemic. So if you have a situation like that where you were extremely stable the whole pandemic, and you were not subject to anything, those are the two ways, for most businesses you're going to qualify. But if you had any kind of revenue disruptions, you've got a head count of at least, more than 10 employees, and you felt like you were messed with during the pandemic, it's worth actually having a professional assess it. Because most of us, will do it as the initial phone call is just a, meet and greet,
Yeah.
that kind of thing. And that's the best way to really tell.
You mentioned 10. Is that the threshold that really you need to, or doesn't qualify you if you have less than 10 employees?
No, that's just the number I usually throw out, because when you get into those lower head counts, by the time because the other piece of this too is how it's filed is on amended payroll tax returns, but you also have to amend your income tax returns for tax credits. So, now you're opening up a can of worms with having to amend income tax returns and, potentially pay some taxes on it. And, for a lot of people, if it's going to be a smaller head count than 10, often it just ends up not making financial sense to pay the professionals to do it by the time, you're going to get a small piece of the pie. So that's why I usually say 10, but it's not, and if you have one employee who is making minimum wage, who's an unrelated person and you qualify, you can qualify for the credit. It's really that and lower limit.
You mentioned something there that I don't want people to miss over. That's an unrelated. Can you define that?
Mm-hmm. Yeah. So, another caveat with this program is if you are a majority owner in a business, you own more than 50%, you and then all of your, any family members or blood marriage relatives that work in the business are not going to qualify. They're going to be non-qualified wages.
Which is crazy to me. I feel
right?
like, because if you're running a business and you're like, hey, I'm going to employ all these people, and they're like, oh, they're related to you? Sorry. Oh, well, I have 12 sisters and brothers, and they all have college degrees, and they are legit professionals. I'm not just giving them a job just to say I have a job.
Yeah. Which I really wish that they had. Yeah. It's so unfair.
I could see the scam part of it too, because if you're like,
oh yeah,
let me give you this job on paper. And so then you have this retention of this employee. It's up to what, $26,000 credit, correct?
Yep.
What is that like? Why would you get less than 26,000? Like, what's that?
Yeah, so I can break that up a little bit. And, I think just to be clear, I think a lot of people don't understand, most businesses do not qualify for the full 26. Like, it's a rare situation where they qualify for the full 26, because basically you can qualify for 5,000 for each employee for the whole year of 20. If you meet the different, if you beat one of the tests, and then you have quarters that are eligible, and then you pay people enough. And then also you have enough wages that, for a lot of people, if you've got PPP, there's an interaction that happens between that and the ERC. So that often will wipe out a good portion of the ERC. It just depends on how much you pay people and the timing. And it's really an idiosyncratic situation. But for tax year 20, it's 5,000. And then for tax year 21, it's the first 3 quarters that are eligible for most businesses. And then in each quarter, you can get up to 7,000 per employee. And we have to back out things like any related parties are not going to count. Certain PPP wages are not going to count. And then just how much you paid people, because it's only a percentage of the wages you pay, up to a $10,000 cap. So it comes down to those factors. And if you have a business, say, that's only qualifying for 1 quarter, then they're only going to get, then that's the only open window for them. So it just really depends on how many quarters they're eligible for, and then how much they were paying people during the quarter.
So if you were paying people minimum wage and you only qualified for 1 quarter, you're probably not going to get a whole lot back.
Yeah, because if you're only paying people, $1,000 because they're, you got a bunch of teenagers working for you or something, you're only going to get maybe at the top, like $700 for that employee. So it's in one quarter. So it's,
Gotcha.
it really is dependent for most service businesses where, say you've got people that are getting compensated, above $40,000 a year, you'll likely to be hitting caps. You'll, hit the cap top amounts, the 5,000 or the 7,000. But it's just really dependent on what the situation was for your company, and how you did your PPP makes a really big difference as well. I've seen that swing the credit.
Yeah, I was terrified whenever
really,
the PPP came out, and so I
yeah,
was like the lowest amount that I could possibly get away with for like a month's worth of payroll,
yep,
and I heard other people were like, "Oh yeah, I got like hundreds of thousands of dollars," and I'm like, "Man, I got like $30,000. Like, what did I do? I did something wrong."
yeah.
And then was forgiven. I was like, "Oh, I'm an idiot. Like what?"
I could have done more.
What?
And that's
Yeah.
the shame about it, because with the PPP program, it was just like a money grab, and nobody knew what was going on with
That's
it.
exactly what it felt like.
And then once
Yeah.
it was gone, it was like, too bad, sorry.
Yeah.
That's why I like this program more, because it's a level playing field. People were claiming this credit during the pandemic. And
Yeah.
then for the people who wanted to wait, which I think rightfully so, until, okay, we need some more guidance from the IRS before I request a 6-figure check back. Like
Because I don't have to
things
pay that plus
yeah, it's like, I
interest
don't want to
onto it.
make a mistake. There's not enough information. And, as the program, we're now at the point where the IRS has released about as much guidance as they're going to on this. And there's, the gray areas have all been resolved. Like, we know how to handle all of the, the major situations. And so now is a good time, if you'd put this thing on the bench because it was like, what, this seems kind of like a mess. I don't want to do this wrong, or, talking to your tax practitioner and they're like, what, I'm not comfortable with this. Now is actually a good time to reapproach it, just because we've gotten good guidance from the IRS practitioners who have been doing it. It's like, we've gotten claims through, we know what the process looks like. It's a lot more, what you're getting yourself into with it now versus during the pandemic. It was like, well, are they going to deny this? Are they going to approve this? Am I actually going to qualify for it? And unlike PPP, this program, because it's a credit and it's baked into the tax code, if you're entitled to take it, it's not like there's going to be a run on the bank or the money's going to run out or something like that. You have a legal entitlement to it. It's like when you file a regular income tax return, if you don't include deductions that you were entitled to, you can go back and amend it and get it. And that's the same thing with this program. We go back and amend returns and
That
get
was
it.
my fear when it first was announced. I was like, it was a fresh wound for me. The PPP scenario
Yeah.
was very fresh. And I was like,
I'm sorry
oh
that happened to you.
crap.
That's
I'm like,
terrible.
and I think I had like 12 people at the time. So I'm thinking 26,000, 12 people, like 300K, like I could get this money. Like, I got to figure this out. And it was like, I was like filling out the PPP, paperwork for, what did they call it? Whenever you didn't have to pay it back, whatever.
Yeah, the forgiveness application.
The loan
Yeah,
forgiveness.
I was filling out that stuff, and I'm the whole time I'm like, oh, I'm just like crying over here, and then I'm reading about this credit, and then my CPA is like, nope, no, I don't. I'm first off, I'm not getting on the podcast and talking about it because I don't know enough about it. And he was like, I'm not going to put you in a situation that I'm not educated about. And so I'm like, oh gosh, man, come on. Like, don't. And the worst thing in the world was what was it that they were giving out money for, but you had to pay it back?
Oh, the SBA emergency disaster loans.
That's it.
It was like a low interest.
You get a freebie of 10 grand, but then the rest they're going to get back. And you're like, are they going to forgive these? Like,
well,
no, they actually
the whole
want
thing.
It back.
Well, I was like, I don't really need this, but it's like, it's a low interest, like such a low interest rate. Like, should I do it? And then like at the last minute, I was like, let me pull the trigger, like click submit. And they're like, money's out, money's gone.
Oh,
and I was like,
worse.
Why do you always get the bad luck, Tersh? I don't understand.
I don't know.
Must be something you do.
It is. You get all the good luck. I get the bad luck. That's just the way it goes with this. So, well, that was my concern. Was like I had just been told that wasn't going to happen, and so I'm like, crap. I need to figure out this 300,000 if it's possible. But the other problem was that we grew 600%
Yep.
during that time. So
Yeah.
it's
Well,
like,
and that's
So
that was
revenues
one
are
thing.
out. Yeah.
Yeah. So
Yeah.
one thing with home service businesses, honestly, this is one industry that
hmm
generally did not decline. Generally, revenues, if anything, were like record highs for most
Yep.
businesses because
do you
everyone was
have
home.
have anyone that had record high revenues but still qualified
Mhm.
another way?
Oh yeah, because it's an either or test. So the first thing we
Mm.
look at, just because it's easier under audit, is the revenues, and then if that's not there, the second piece we look at is the government orders. So if you're in a home
Okay.
service business in a low regulation state, like say you're in Florida,
Georgia.
or Georgia,
We
though it
didn't shut down
depends
for
because
anything,
it's
really.
you have there were county level restrictions and things like that, and then you have certain metro areas that have their own restrictions. So it depends, but if you were doing some kind of home service work, and you really just didn't have any kind of government restrictions other than maybe, people having to wear masks and, stuff like that, where it's not operationally changing things for you.
Yeah.
Then it's not going to be an open door for you. But
What
it's like
if
what you
you're
said,
if
when it's, even if you've got, 10 people say you qualify for one quarter,
yeah, is it worth it?
it's worth
And
it.
Probably
then
worth
and
at least
then
investigating. I would
Yeah.
at
well,
least to
my
look into
thought
it, right?
my thought, and correct me if I'm wrong on this, is it worth putting yourself out there for the potential audit if you're only going to get a couple $1,000s back?
I guess that's a risk tolerance that it's just up to you as the business owner. What I would say, at least on my side of things, if I don't anticipate the audits for these to be that harsh for
Okay.
my practice, just because we build the audit file when we do the claim, and
Oh, okay.
we know kind of what they're going to ask us for, and we've
Yeah.
built the file based on the FAQs and the notices and the guidance that we have from them. So we're anticipating their audit regime is going to mimic what they gave us for guidance and just how they audit other tax programs. So on my side of it, because the other piece of it too with my firm, and I think this may be a unique distinctive, is we basically treat any kind of IRS inspection as part of the original engagement, just because we're expecting a lot of that.
Oh, really?
Yeah, so I don't, like, in my firm, we don't charge extra for the audit, because it's like I've already done all the work that's going to go into the audit when we do the claim, just making sure the claim is done right. So,
Oh, okay.
I think for most business owners, as long as, if you're going to pursue this program, that's definitely a question you want to ask the provider is, what's the deal with audit? Are you guys going to be able to get us through it? Because only certain people can represent you before the IRS. They have to be an attorney or a CPA or an EA, or, there's a couple other small designations that I think can do it. But, that's kind of the main hang up, I think, for most people, is the IRS, IRS audit
Oh, yeah.
on these.
Absolutely.
Because they just rubber
I get
stamp process
something.
them. So
I get
Well, it's
something
painful.
from the IRS,
Yeah.
and I'm like, oh God, haven't even opened up the envelope yet, and I already have an anxiety attack. I'm like,
yeah,
shaking.
you see that
opening the
little like
door.
logo for the
Yeah.
treasury, and you're like, no.
Man, I hope this is a scam letter. Oh God, I hope this is a scam letter. And then you open it up, and you're like, oh, it's just nothing. Oh God,
Yeah,
I just
it's like,
had
hey, just letting
anxiety.
you know, we got
Yeah.
this. You're just like, oh my gosh, I was having a heart attack.
Like, really? That could have
Yeah.
been an email. Like,
Yeah.
Well,
you know?
I'm glad they don't do email.
God forbid the government try to do
That's
anything
true.
via email.
Yeah.
true.
Oh man,
No,
they've
that's
just
true.
now started to let us, like, they're the one service left where when I call them and actually get through to somebody, which is a miracle, if they need something from me, I have to fax it. They're the only person left that's like,
What?
nope, you got to send it via fax. And I'm like,
Fax.
yeah. And so
Really?
I have to use an online fax. I don't have a fax
Yeah,
machine, so I have to use
right.
an online fax
Who
program.
has a fax machine anymore?
I know, the IRS does.
You have to do that Adobe fax, e-fax, or whatever.
Yeah,
Yeah,
you'll there you find
faxes.
Wow.
Cool. Catherine, we really appreciate you and hanging out with you, and you've helped ease my mind a lot, that's for sure. Now, I want to ask one last question. This, just for clarification, this ended in 2021. So if you had a decline in 2022, you're just screwed.
Yeah.
Okay.
Yeah, it's only for 20 and then the first 3 quarters of 21 for most businesses.
Okay.
Okay. That's good
And
to know.
yeah, cool deal. Now, if somebody has a CPA, but their CPA is like, look, I'm not comfortable doing anything like that, Are they okay with reaching out to you?
Oh yeah, no, we do this. I'm kind of the ERC department for a lot of other practitioners who don't want to handle it.
Okay.
So we work really nicely with the existing tax professionals because, like I mentioned, I hope I mentioned this earlier, but the tax credit interacts with your income tax situation. And when you file for a credit like this, you will have to amend your income taxes. So we need to work hand in hand with the existing tax professional to make sure that's done right. So that's, a lot of practitioners call us in because this is a specialty tax issue.
What's going to happen? I said that was my last question, but I promise this is going to be like one of my last questions, hopefully. What happens if 3 or 4 or 5 years from now, the IRS decides to kind of change up things? They're like, oh, wait a minute, let me change. Is there going to be like a grandfather in there? Like, okay, well, this is what we understood it to be at this point in time. But now you went and changed things.
Yeah. So basically, I guess to back it up a little bit, when we have changes in the tax code, it comes from Congress.
Wow.
So Congress is the one that gives us, okay, this is what the program is, this is what the rules are. And then the IRS then interprets what Congress puts into law, into protocols. They give us forms to use. They issue guidance around their understandings of certain treatments and things like that. So unless we have a law change on the government side, the program's not going to change. The places where there are still gray areas in the program are, pretty small. Okay. So there's not really going to be something where the IRS comes back and says, oh, we're actually going to reinterpret this piece of this thing. That's not really going to be an issue with this program at this point. The one piece I would say, though, is that if you have a bad claim done, so if you work with a provider who doesn't know how the program works really well and makes mistakes, or, doesn't keep good substantiating documentation for you, and then you get audited, there's not going to be a lot of mercy there. So you're still going to be the one left holding the bag. Say you worked with somebody that you thought was good, but it turns out they didn't save any of the government orders to your folder, and now the government orders aren't available anymore, and the IRS, that's what they're digging into.
Yeah.
And then, they're going to come after you for the credit and interest and penalties.
Penalties and interest.
2 years from now. So it's going to be a lot.
They're going to be like, oh, yeah, let's wait. Like that's when you get your car towed.
And I've seen that happen where they'll sit on stuff and then they'll open up a whole bunch.
They're always like 2 or 3 years behind.
Yeah, and with this program, it's
why are you sending me a letter about this now? God, it took you that long.
Well, the worst thing in the world is getting that letter saying, "Oh, you owe $1,500, but we just gave you $3,500."
Right, like you couldn't have figured that you couldn't have cross-referenced your records to figure that out before you gave me this.
Yeah, which sometimes they do. Like sometimes, if you owe back taxes and you try to file for this, they're gonna, okay, we're gonna pay off your back taxes with the credit, and then we'll send you the difference. Like they do some things like that. But yeah,
that's probably why they hired
major time
7,000 people.
Oh yeah, they really needed it. It's really bad over there. For me to try to even talk to somebody we get a special hotline for tax pros. To even get somebody on the phone, it's been impossible.
So with that being said, have you noticed more audits since they hired so many people?
Not yet. So they've got a special task force for this program. And then basically, with this program, there's a delay with the processing. So you file it. It usually takes at least 3 months for them to get you the checks back. But they're just processing them. So they're not really, for the smaller ones, they're just making sure that basic things tie out. Mm-hmm. And then they're just going to cut the checks. It's really the enforcement's going to happen after the fact. For some of the larger claims, we're anticipating that they're going to, double check them before they just cut the checks. And it does go through some kind of second inspection, but that doesn't that doesn't mean, okay, they do that and now you're good. I think there's just going to be a really large enforcement effort on this program because there's just a lot of negligent work being done out there. Like I'm already starting to deal with some of it. People overstating because, when we file for this, it's just a couple of things we change on the actual payroll returns. And then it really is relying on us as a tax professional to do all the back work right. And that's something where you could just have somebody say, okay, I'm going to do, it's all the employees, we're going to max out the credit. And then you just put it on the form and send it to the IRS and they'll send you the check, so there's a lot of that kind of stuff going on where people haven't done the real work behind it and just, filing these negligent claims. And so,
As
it's going to be a big issue.
as a contractor themselves, how can we make sure that we don't have someone like that?
Well, I would say,
Other than obvious, like
the
let's
obvious.
call, Catherine.
Yeah, I'd say the first piece is you want to work with tax professionals. So you want to work with a company that has a tax background, and that's what they've been doing. You want to work with a company that pre-existed the pandemic, because a lot of people just popped up just to do this. And then you want to work with a company where when you go on their about page, you go to their LinkedIn page and you scroll through who are the actual people that work here. It's mostly tax professionals and other, related people, and not just, 50 salespeople. That's the piece you want to really look out for, because if you're working with like a credentialed CPA firm or a law firm that does a lot of tax work, or an enrolled agent who, does other work besides the, the ERC or that sort of thing, you're going to probably be in better hands. But I would definitely say, that's what you want to look out for. When you're talking on the phone to people, are you talking to a salesperson or are you talking to a tax professional? It's like you'd be a little sketched out if you went to the dermatologist and we're talking to a salesperson to like look at the thing on your neck, like so that's kind of the feel. It's like, it's a tax credit. So you should be talking to tax people about it. So that would be the main thing. And then the other piece too, that I kind of caution people on, just based on my personal experience, is there are a lot of payroll providers that offer to do this as a service. They usually charge pretty low flat rates. And my experience with them has been that it's kind of a loss leader product for them, because they want to keep the regular payroll business. And so they're just trying to like get these
Lord
out the
help
door.
us. They can't even get payroll right. So
so I would watch out for that as well, because I have people where they're like, oh, I'm going to have, insert big payroll company name here, do my ERC for, $1,000 or whatever it is. And it's like, for that amount of money, there's nobody looking at it. Like there's no tax professional looking at that.
no.
And then especially if you've got any kind of complex business situation going on where you've got a decent head count, maybe you operate multi-state, maybe you own a business and a family member owns another business, and you kind of have some overlap ownership. So now you're considered an aggregated claim, things like that. If you have anything like that going on, you're just going to want to talk to somebody that's credentialed for it.
Yeah,
sure.
Very true. Very true.
We did have a question.
He came on kind of late in the show. But Eric Thomas, he asked, can I qualify for the ERTC if my company started in 2020?
The answer is yes. There are different rules for it, and it's usually more limited, but yes.
Okay. It's good to know, because I know I've talked to just clients we have. They started like right before the pandemic or during the pandemic type of thing. So it's something for them to keep in mind as well if you're listening to this.
Mm-hmm.
Cool. Thank you again so much for coming and hanging out with us and answering all these questions.
Yeah, it's my favorite topic to talk about.
And if you're listening to this or watching, don't forget, go to their website. It's dominiones.com. Did I say that right? dominiones.com. Okay.
Yeah,
nailed it.
They do have the whole, if you see if you can get the credit. I don't remember what this call to action is. It's on the top. Yeah. See if you qualify is on the top right hand side of that page. So if you go to that page, you can. I don't know if it's a couple questionnaire.
It's just a few questions, and then we can set up a phone call just to kind of do an exploratory, see if there's something there. The other piece too on the website that's helpful is under our resources tab, there's a for business owners page that has a PDF in it that's my top 5 ERC mistakes that goes into depth on, the common mistakes I see business owners make when approaching this program, and kind of the red flags and decision points that you have, when approaching something like this.
Cool.
Okay.
Thank you so much.
For those listening, we'll put that in the show notes. Yep. It is on the screen right now if you're watching this live, but we'll put that in the show notes for you.
Cool. We appreciate you. And if anybody has any questions, don't hesitate to reach out to their team. Obviously, they know a lot about this. And I could ask 1,000 more dumb questions, but we will wrap the show up. So thank you again for watching and hanging out with us at the Service Business Mastery Podcast. And we hope you have a wonderful and safe week until we talk to you next time. We'll see you.
Thank you for listening to this episode of Service Business Mastery. Now that you are equipped with essential business advice from this impactful conversation, you are one step closer to becoming the successful owner of your dreams. If this episode has been helpful to your business journey, don't forget to subscribe to the show, leave a rating, and share it with other owners as well. Visit servicebusinessmastery.com to learn more.